as a student are trying to learn what it is I'm teaching and hopefully try to adopt some of the mindset things that I've acquired over the years that help me to mainly avoid losing, where as a younger man, I was more prone to losing, jumping into these environments. So I will talk a little bit about that today. But understand that it's normal for you as a trader, as someone that's new, trying to learn how to do this, to feel like you have to do it all the time. Otherwise, it feels counterproductive. And it seems counterintuitive that you should try to learn how to trade to learn how to trade less. But that's in fact what you should do. And it doesn't feel that way. It doesn't feel that way because of the way the industry is built around commission based activity, everyone trying to get a piece of the action. And you have educators that are trying to sell you something. And I used to be one of them. You have brokerage firms that want to charge you commissions and fees. You have services and softwares that want to try to get a bite of the action as well. And all of those things, all those outside influences, they're all going to get paid before you do. Just like a job, tax man cometh. you can't you can't escape it. Okay, no matter how much money you have, in some way, shape, or form, if you're buying something, or if you're selling something, if you're acquiring something, or running a business, to some degree, you're gonna pay something in taxes. But in the pursuit of profitable, consistently profitable trading, the common denominator is avoiding overexposure and over-leveraging. Now, overexposure and over-leveraging, it's not me amplifying the same thing. It's two different things here. Overexposing yourself and your account to risk is not the same thing as over-leveraging. Okay, to eliminate the over-leveraging point of it, because it's easier to do that and shorter. Over-leveraging is simply adding more contracts than you should be willing to take or that you should be allowed to do because there's an exorbitant amount of risk associated with trading more contracts. And a perfect example would be I'll just use the prop firm models because they unfortunately are guilty of this. Allowing 15 contracts for $150,000 combine or whatnot, and only offer you amount of pseudo leverage or not leverage, but drawdown before they take away the ability to trade that combine or account. It's disproportionate. It shouldn't be allowed, and I think that is one of the things that should be cleaned up. If you're going to see the prop firm industry continue, I think that they should be more realistic. If they're really in it to help you win, they shouldn't allow you to blow your own brains out. Because if it's their model to try to coax you into doing it properly and trade like a professional, professionals don't trade with 15 contracts when they're only allowed to lose, a couple $1,000. It just completely flies in the face of sound logic. So over leveraging is not what I'm talking about when I say overexposing. So over leveraging is just simply doing too many contracts per trade, opening yourself up to monetary risk that is exorbitant based on the equity base that you're working with. So with that out of the way, overexposing yourself. That means going in more times than you should, pursuing, chasing opportunities that you want there to be opportunities in these conditions. What conditions? Whatever that condition is that allows you for you to sit in front of the charts. If the markets are open, prices are fluctuating, you think that it's now open season, it's hunting season. Maybe. But understand this. While you may adopt that mindset that it's open season for you to go out there and start seeking opportunities to be Elmer Fudd and have your little shotgun in hand, and you want to go out there and chase Bugs Bunny, you want to go out there and chase Daffy Duck. Okay, and if you don't know who that is, it's in the States, they're cartoon characters. And everybody starts off at the beginning of the week. They're all out there like, yeah, man, let's go. I'm going to find me an opportunity. I'm going to take me something home. And because the markets are trading, there's opportunities to trade. And everybody has this idea of what makes the markets go up and down. You overexpose yourself to what you think is a plethora of opportunities 24/7. The only opportunity that exists in that mindset or that, well, reality is the market itself sees all of us as us being served up on a dish, like a plate for it to devour. See, the market can chew us up, ICT included, can bite me, chew me up, and take from me. So I have to learn to avoid certain circumstances. Over the years, I've done that. I didn't do it quickly. I didn't try to get through it fast because I didn't understand that it was something that I would incur or have to go through because I was too limited in my understanding as a 20-year-old when I first started. The books didn't talk about these things. They just talked about following your setups, pushing your edge, trying to do more. Very little was ever spoken about doing the least. And if you think about it, it would be very hard to market that even today. You're going back to the 90s, 1990s for the folks that are millennial. Like my youngest son says, Dad, you're from the 1900s. like it's like centuries ago. But in trading, a lot of the industry today is young folks, and it's have it your way right now mentorships. They want it instant gratification. They want instant, feedback where profitability is overnight and it's assured. And they don't like to be told or reminded or encouraged that it's going to take a lot more time, a lot more energy and effort to get to that point. And some of you are going to fail, not because of the things that you learn from me or anyone else. It's just simply that you're not equipped to do this. It doesn't mean that you're forever ill-equipped. It just means for that moment in time, you may be ill-equipped. And you will have to accept the fact that you will fail on the temporary. Now, that stays temporary if you allow it. But it becomes final when you choose it to be. So taking breaks, calling it quitting, whatever, that's normal. I did that. I did it dozens of times as a young man. But overexposing yourself is constantly seeking opportunities and insisting that they're there, forcing them. And because you know that there's a likelihood, there's a potential for the market to create opportunities where it might be big moves this coming week. It might be big moves in this coming trading session. There might be large range expansion days. If you're a commodity trader, we could see limit up or limit down days where the opening is the only fluctuation in price from the previous day's close, meaning that wherever the previous day's close was, when that commodity would start its trading for the day, it opens limit up, the highest it can move, the maximum amount of fluctuation in movement from the previous day's settlement price. It's not allowed to go any higher. And it doesn't trade off that. It just stays there. So when you look at a chart, it just looks like a little hyphen, a little dash. The open and the close is the same price. That's a limit up move, and vice versa. When the market's going down and it's dramatically being repriced, not buying and selling pressure, and that's how you know it's a myth. Buying and selling pressure is a myth. That's not what causes prices to go up and down. Because if that was the case, you're trying to tell me, and I make this argument all the time, a limit up day. It's lock limit up. Okay. Why can't I and why couldn't I sell out of my position? I wanted to take profit. I couldn't. You're trying to tell me that there's not one person out there that were interested in seeing any lower tick to be able to offer one transaction outside of just the opening price being the only price of the day? It's a myth, folks. It's a myth. So all of these ideas keep flooding into your mind as a trader, And you understand that we do this to make money. You might have other subordinate reasons. You want to look smart in front of your girlfriend and your boyfriend and their family members. Carl. um, but the number one thing should be you're trying to make money. And that's a very powerful influence. It's very powerful. It will place you in the pursuit of things that are not really there. You'll chase things that are phantoms, like trend lines. That's why I literally call them trend line phantoms in core content. Because you want this to be a diagonal support level. You need it to be because it provides you the venue on which you're going to act on and say, oh, yeah, this is the time where I want to be a buyer. Because everybody's going to see that area too. They're going to want to buy too because this imaginary two swing lows, if I extend a line from those two, that imaginary decision point in the future, everybody's going to have that same decision point and want to buy there too. And I capitalize on that. I look for opportunities for those types of things. And when you overexpose yourself seeking opportunities where there may in fact be opportunities there, but you become the liquidity. But you won't see it that way walking in. You won't see yourself laying yourself on the altar of these markets. Sacrificially just laying yourself out there. Consume me, take me, pick me, burn me up. Dismember me. Willingly doing it. But you walk into that condition thinking that you're going to leave in a gain. And the only thing you've gained is experience about not, hopefully, wanting to do that same thing again. And it took a lot of repetition for me to get really displeased with chasing something. Whenever I got really anxious that I was going to miss a move, or if I was really excited about a particular trading week over the weekend, they were the characters that constantly came up in the play that resulted in me losing. Sometimes losing an entire account. Now, I don't know why when people are new, they come here and they want to listen to me or whatnot. And I'm honest with you, and I tell you where I learned from, and it was through pain. It was through adversity and lots of blown accounts. For some reason, that seems to be like a bad thing for you. Like I would want to learn from someone that has gone through the pain, has lost a lot of money, and learned how to avoid doing that again. That's the person I want to learn from. But unfortunately, that's what I'm trying to tell you many times when I said in this discussion this morning. You're talking about how to trade less. If I wrote a book and it titled it Trade Less, nobody's wanting to buy that book. Now there might be a little niche market in there because it's my name on it, and people want to hear what I have to say about it. But by far and large, they're not really going to be interested in it unless you know who I am, and you're already interested anyway in the things I'm talking about. You probably wouldn't be a buyer of that book because what is it telling? It's saying something that is contrary to the consensus that this industry has cultivated, which is always do the most, never relent, maximum effort, to quote Deadpool. And unfortunately, in the 3 decades I've been messing around with these markets, I've learned that less is more. And I've also learned that I was prone to overexpose myself to risks that I didn't understand or could identify as risk because I was falling victim to the things that I purchased in terms of courses and books and people teaching this and that. And because I wanted to change my life, I didn't want it to be the mundane Michael, the average Joe. I was seeking and pursuing something that was bigger than just regular. I didn't want to be the regular guy. And everything that I picked up, I've always demanded it to be exceptional. And I was very disappointed that everything that I purchased and everything that I absolutely worked very hard by their rules, I followed it by their rules, and it would not work. It would not yield to me the results that they promised. It would not yield a consistency and a visibility to be able to see these things forming beforehand. And it caused me to jump into the very next thing, the shiny new object syndrome. And even in this community, because if I teach something new, I talk about something new, everyone's so quick to let go of what they're already working on, that they've had progress in, and beginning to see the stages of development that hasn't happened fast enough for some of you. And because it hasn't happened fast enough for you, and you haven't had a payout yet in a funded account, or hasn't seen a profitable live account yield you a withdrawal yet, you haven't got to that stage yet. It's there waiting to be had, but you haven't got there yet, so you're impatient. And it's easier for you to say, well, this looks new, and everybody's going to be talking about this new thing. So I'm going to be distracted anyway, and ICT is going to be jawboning and going on and on about this new thing. So I might as well just go ahead and chase that, because who knows, it might become easier. I might be able to get this faster. And faster is a recipe for disaster. And I was a pellet, didn't even know it. The idea of trying to do something quicker for the sake of getting through it. I want to get profitable. I want to get to a point where I can see the setups form real quick, looking at any time frame. The way you get to that level is constantly exposing yourself to back testing and watching live price action. You do not get it by overexposing yourself to risk. Because when you incur risk and you haven't learned how to do it properly yet, what is it? What is the subject matter I'm referring to when you haven't learned how to do it properly? Well, there's a number of things that encapsulate the it. It's number one, mastery of yourself, because you're never mastering the markets. I have not mastered the markets. I may look very, very versed in executions and managements and whatnot, but I still, and I can tell you that there's about 8 times this week that I would have lost. Whether it would have been a demo account, whether it would have been me calling it out in Twitter, if it would have been me dealing it with a live account, I would have taken 8 losing trades this week. And it would have been no fault of my concepts. It would have been me trying to do something that I am, as a human being, prone to do. So when I say that, that's not a weakness, that's a strength. But because when I was a 20-year-old, I viewed it as a weakness. I viewed it as, I would lose on a trade, and I think, okay, this makes me poor as a trader in every sense of the word. I have less in the account if I had the account remaining, or I'm less inclined to chase the next setup because now I'm scared. I don't want to incur another loss because I didn't come from money. And when I would take a $300, $400, $500 loss, those hurt. That was a big portion of the account that I was working with. And it took a lot for me to get these couple $1,000s scraped up to refund an account, paying exorbitant amounts of fees and paying for all the little bells and whistles for the data and the software programs that I was trying to constantly build up.
I don't think most people realize this when they first get into trading, but there's always a very specific phase, a painful phase, that every successful trader has to survive before things finally start to click. I'm talking about the phase where nothing seems to go right, your confidence gets destroyed over and over again, and you start questioning whether you're even built for this.
I went through it. The people in my trading community went through it. My mentor went through it.
When you're trading, it's important
for you to have not just one single time frame. You're going to execute on one time frame. You're going to have all of your analysis built on a higher time frame chart. That would be, in this case, if we're going to be scalping, because I'm attacking the idea that you can't make money scalping. You absolutely can eviscerate the majority of what everybody else thinks is a good return. You can literally do that every single day. Scalping, you can do every single day. There isn't a day that you cannot go into the marketplace and not make money trading as a scalper. You absolutely can do that. The problem is you're going to go in and try to do it more time than is necessary for you. If you go in and you made $2,000, you're going to feel really good about that. And it's going to feel like, wow, I want to spin the wheel again. I want to throw the dice once more and get that feeling again. And that's what you have to fight as a trader. You have to fight that urge to do that. And as a scalper, you can go in there and go insane, make lots of money, have a long series of winning trades, and then do something stupid, regret doing that, try to get it back, and it turns into blowing your account, going into severe drawdown. You've seen YouTubers do this. You've seen influencers come out and be honest and say this is what they're plagued with. And I'm trying to help you if you listen. But you have to have multiple time frames that you're going to be referring to. I'm going to drop down below a 1 minute chart too to show you the significance of what price is doing on these lower time frames, sub 1 minute. Every single hour, there's an opportunity for you to scalp. Every single 15-minute interval, there's an opportunity for you to scalp. Now, the problem is, and I found this out to be true for myself when I first tried to do scalping in the bond market in the 90s, I could see these moves on the very small time frames, and then I would get married to the idea it was going to give me more than what I subscribed to or framed for my trade. And what do I mean by that? Let's assume for a moment that we were looking at these lows down here on the 1 minute chart. Okay. And let's assume that we were considering how the market is recently trading at all-time highs. And I'm going to address that here because it's also a question that keeps coming up a lot still, even though I answered it in my comment community section on my YouTube. When a market trades into all-time highs, I am completely in the same category as every other trader. I don't know what it's going to do. I don't know how far it's going to go higher. You don't know how far it's going to go higher. You don't know when it's going to stop. You don't know if it's going to reverse. No one knows that, folks. No one knows that. So it's a very interesting condition to be in as a trader because I know lots of things in how to trade inside of a range, outside of a range, but at all-time highs, I have no tools. I have no tools. I have a blank canvas in front of me, and I have to wait for the paint to be applied to the chart. I gotta work with what it gives me. And in my mind, this is the way I interpret it. Since we traded to all-time highs, I don't want to go against that. So I will look to take buy signals until those buy signals prove to me, not just by one losing trade, not by two losing trades, but if I go through a series of several days in a row, and if I'm buying and it's failing and I'm going in drawdown, and yes, I can go into drawdown. This is exactly where I would incur it because I'm in a discovery, just like you are, of whether or not the market is going to allow for prices to go higher. Now, with that premise, we can see that we are in 7 o'clock in the morning. So 7 o'clock is the New York kill zone. So at 7 o'clock in the morning, I can start looking for setups in any market. And I said this before, but it goes over the heads of some of you because you're not really doing too well in terms of taking notes. There are things that I'll talk about that are specific to Forex, and there are things that I say that are specific to futures. And unless I say that at the time of me teaching it, everything I say is universal. That's my belief, okay? So at 7 o'clock in the morning, that starts the New York kill zone. So if we have that delineated, sometime after 7 o'clock, I'm bullish. Why? Because we traded to all-time highs. I don't want to try to pick the top. I don't want to be a sucker and try to do something that's impossible. So I want to look for areas where the retail trader that wants to sell short or try to pick the top, or aggressive traders that think they're going to outsmart the marketplace, they're going to buy early. And by buying early, they'll place a stop loss below a low that forms just after 7 o'clock in the morning. So here's 7 o'clock. We have a low. We went lower here, but see how shallow that was? You see that? Does that imply a continuation the rest of the day? Probably not. And as we get closer to 8:30, 8:30 is usually a turning point, because whether there's news or not, and there really isn't any news of any significance until 10 o'clock today. Some kind of manufacturing index number or something. And we'll get to that when we get into 9:30 going into 10 o'clock with the opening range. But this low here, this run here, it runs to this high to take out the liquidity. This low takes out the liquidity below here and here. But this is what's going on every single day. The market will trade to liquidity for the purposes of stopping out people that would be profitable at a later time when the market does run. So what is our bias today? It's the bullish bias. We're not trying to pick the top on the daily chart. So we're focusing primarily on being long. When do we start looking at the charts? At 7 o'clock in the morning, it starts the New York session. Do you need to be in front of the charts at 7 o'clock? No. Can you start at 8:15 and wait for 8:30? Yes, that's a good time too. You're not locked into that, because I just told you at the beginning that every single hour you can scalp. Every single 15 minute, there's a scalp. Every quarter part of 1 hour, there's a scalp. But it isn't going to run 100 handles all the time. So you have to strip it down. So what's the minimum that I would like to see for trading and scalping the NASDAQ? It's 10 handles. If I can't at least make 10 handles, and I'm going to tell you how to determine that, okay? But if I can't make at least 10 handles, I'm not willing to take the trade. I don't care. I'll let it go. And there's lots of setups that I see all day long intraday, if I'm in front of the charts, that I will say, okay, I think it's going to do this, but I don't want that one. And I'm going to tell you how to determine that today. This is one of those lessons where you have to let me talk, but I promise you're going to see it, because I'm going to show it to you in charts real time. But if we don't have an expectation of what we're focusing on going in, we're wasting our time here today. And I can push buttons in front of you and make all kinds of pseudo profits, and you'll leave knowing nothing. And that's not why I'm here. I could keep going back and making videos of me doing executions and showing you that way. And that's fascinating. It gives you study homework. But I'm here to teach you today. So if we look at how the market dropped down and it took out these lows here, see how they're relatively equal? See right there? I'm going to take this vertical line off because it's a little too aggressive. When we see that low right here on the 5-minute chart, see it right here, right above my cursor? That is this low right there. Okay. Go to the left of that low. What do you see? That's a down close candle. That is an order block. Friends and neighbors, that's not a supply and demand zone. Okay. It's not. What this is a candle that is opposed. It's closing lower. So it's a down close in a market that's predisposed to go higher. Why should it go higher? Well, go up one time frame from the 5-minute, and it's the 15-minute. What's right here? See these smooth highs right here? I'm going to annotate that. There. Okay. So you see this high right there? Look where it goes to. It goes right there, stops, and comes right back down. And does what? It unsettles the longs that had a stop loss right below that low right there. And then the more prominent run takes place. And it's reaching up into this high. So on a 15-minute time frame, whether I'm scalping, whether I'm day trading for the full daily range, or if I'm short-term trading, regardless of whatever I'm doing, I am always referring to the 15-minute time frame as my bellwether time frame. Because on the 15-minute time frame, let me maximize this real quick here. On the 15-minute time frame, this is going to give me all of the salient points of liquidity that I believe is going to be pertinent to the session that I'm going to trade or about to trade. And it also will have the built-in advantage of showing me the daily levels that I'd be interested in if I'm just going to trade the full daily range. If I want to get the lion's portion of that full daily range, whether it be an up day or a down day, I can determine those points of liquidity, whether it be buy side or buy stops, or sell side or sell stops, and clearly and easily see them on the 15-minute time frame. And I can also see all of the pertinent imbalances, whether it be a sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency, meaning a fair value gap with an up or down close. And right now, when we see price here, afford me the ability to talk about this because I did an execution before we started, and I'm going to walk you through that. That's what I'm doing here. And then I'm going to do another one after I go through that. And then at 10 o'clock, I'm going to do another one live right in front of you. I'm going to put the trade on. I'm going to put the stop loss on. I'm going to talk about every single candlestick that I believe is going to paint after that. But allow me the floor to do it like this, okay? If you see this setting here on the 15-minute time frame, now think, we start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? Folks, I would have paid money for someone to teach me what I'm going to show you today. And you're getting it for free. That's worth a thumbs up. All right, between 2 o'clock and 5 o'clock in the morning, that is the London Open Kill Zone. Why is that thing taking forever to make a box? There you go. So from 2 o'clock to 5 o'clock in the morning, what's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. I'm not a breakout trader. We'll talk about breakaway gaps today too, by the way. The idea of focusing on a bias that is bullish on the daily chart, weekly chart, monthly chart, we're expecting higher prices. We're not resisting the likelihood of higher prices and a new all-time high on NASDAQ. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Is price dropping? Yes. Is it dropping to some random level? No. Look over here. Below that low is going to be what? Sell stops. So traders that see this low and break below that and it's consolidating, someone's going long there. I don't need to know who it is. There's always going to be buyers and sellers. Always. But that buyer or seller pressure is not what causes markets to go higher or lower. The markets are absolutely rigged. They're engineered to go higher or lower because whatever the market is in fact trying to reach for, buyers or sellers, they're not pushing it there. The market's going to go to where the liquidity is, and it will keep repricing until it gets there because it's a game that's controlled by them, quote unquote. Okay. If you understand that and just warm up to the idea that it's rigged, initially it sucks when you think about it because you think, well, I have no chance. But when you realize it is rigged, now you do have a chance because it's rigged. It's not random then, right? So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, most time, between 2 o'clock and 5 o'clock in the morning, London will create the high or low of the day, whether it be Forex, whether it be index futures, it doesn't matter. This is a truism. Do not take my word for that. Go into your charts and study it. Now, because it does that very thing here, right at 3:30, and that's an interesting time because if you go through my private mentorship core content lessons right on this YouTube channel for free, you'll hear me even teach about that right there. And that's the low of the day. Now, when it creates that low, we want to see some kind of displacement to the upside. Because if it does do that, that's indicating The algorithm is flashing like a billboard sign to smart money who trades on it. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high, because right above short-term highs is going to be what? Buy stops. And or a fair value gap above market price. Okay, so if we went down here, where is there a old high and where is there an imbalance? Well, between this low here to this candle here, what is that? That's an imbalance. It's a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI, sell side imbalance, meaning it moved predominantly more to downside, and it's inefficient in its buy side delivery, meaning since it's one big candle that went down and closed lower, you want to find the previous candle to it and the candle after it. Those are the range extremes that you're annotating. So down here when it hit the stops, first thing in my mind is, okay, how do we trade after that? And it should go into this gap here, which is being shaded. Does it do that? Absolutely it does. Then it creates what? Another gap here. This is a buy side imbalance, sell side inefficiency, because it's a fair value gap that has an up close. So while I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. So I'm looking at it like a rock climber would, okay? I look at this entire drop here as a rock or cliff on a rock. And I want to climb all that. I might not be successful making it all the way up to the high or to the zenith of it, okay, the top of it. I might not be equipped to be able to get there, but I might be able to climb up high enough and get the memory or the visuals or maybe a picture of being at that point. Well, in that case, it's here, which is what I mentioned earlier when we were looking at price action on the 1 minute chart. But when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. So what's above that? Another gap. We'll get to that in a minute, okay? But the market rallies up and it leaves this imbalance. Okay, I'm going to move this box over a little bit by one so that way we can see. And I'm going to zoom in also. I promise you folks, this is exactly what's missing from you watching price action live. When you start looking at it like this, I promise everything will start clicking and it'll feel like it's illegal for you to know what you do. So this buy side imbalance, sell side inefficiency, I'm annotating the high of that candle and the low of that candle. And I'm focusing on the range between those two price points on this candle here. So when you see me putting rectangles on my chart, that's not a supply and demand zone. I'm looking at how this offered buy side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside or offer it through sell side delivery. This is buy side delivery when price is expanding higher. This is sell side delivery when it's offering price as price is dropping. Since I've seen it price drop down here and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. I don't need to. I don't need to be awake. In fact, I wasn't to see this. If I was awake at the time, I would have